Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk in today's market. I am your host, Kevin Horner. I'm joining you from a beautiful and sunny Denver, Colorado on this first day of November. Today, I am pleased to be joined by a friend of mine, a Schwab regional trading consultant, Mr. Jeffrey Abalos. Good morning, Jeff. Good to see you, man. How are you?
Hey, I'm doing great. Very, very, very glad to be here with you this morning, Kevin. How you doing, buddy?
I am terrific. Following a holiday weekend, a Broncos victory, but I got to ask you, man, it looks like you got your haircut there, buddy.
Yeah, a little bit. And for all the viewers out there that are going, wait a second, what happened here? This is what happens when you fully commit to your Halloween costume of being Dr. Evil. So I went full on, never shaved my head before in my entire life, but I thought, you know what? Now's a great opportunity to do that, and so I did it. For those of you out there who do shave your head or have shaved your head, you know, it gets a little cold the very first day that you do that. So that was a fun sensation, but very glad to be here with all of you.
Excellent stuff. And like to see that you're fully committed to the process of Halloween. Good for you. Hey, everyone, we're joined by Brent Moores in the chat. He's going to manage things for Jeff and me today. He'll answer questions we're unable to get to, but of course, we want to hear from you. Please use the chat to submit questions. We'll try to keep an eye on things and bring your questions, comments, etc. into our discussion. You can also follow Brent and me on X. I'm there at Kevin Horner CS, Brent at Brent Moores CS. The best way to meet up with a coach outside of the classes we offer you here is on X. So we would appreciate a follow there. Let's get to our disclosures, and then I'm going to remind you of a couple of other key components about Schwab coaching here momentarily, and then we'll dive right in. So please remember that our discussion here is essentially and fully informational and educational. What we mean by that is we're not here to make recommendations nor endorsements of how to trade the market. We are here to talk technical analysis, though. As we do that, we'll remind you that it's merely one piece of your decision making. We discourage you from basing all of your entry-exit decisions exclusively from technical analysis. Now, in this class, what we do, I'll show you here an agenda. We take a top-down approach to review of the market. So we will look at the major indices this morning. We'll look at the S&P 500, the NASDAQ 100, the Russell 2000. We'll expand into some industry groups like the semiconductors as well, maybe some sectors that are in leadership or lagger positions today. And of course, some other areas of the market that could be pertinent to us: gold, silver, oil, etc. So that's usually what we get to here in this class. And I'll let you all know, we do have a bunch of new attendees today. So just a heads up, this one we offer you 4 days a week: Mondays, Wednesdays, Thursdays, and Fridays. So would love to have you join for our live discussions here. Now, before we get to the charts, I want to also remind you all that you have a good way to follow us and pay attention to what we are offering you here on the channel. That begins with the Schwab coaching calendar, schwab.com/coaching. If you come to the live webcast and virtual workshop link, you'll find everything that we do for you on a Monday through Friday basis. We offer you 6.5 hours of live content right on the channel, the majority of which is then archived and available for your view at your time frame. So keep that in mind. And then the last one I'm going to point out, everyone, is our in-person events. You may not even know that we are out and about amongst all of you. We travel the country about 20 plus times a year. We make available to you these free events. Come join us for one of these. We have both market drive events where we take the macroeconomic view of what's happening in the market and try and decipher that for our attendees. And then we have our workshops as well, which allow you to bring your device, come out and meet coaches, have a nice discussion over 2 days. We take care of parking, we offer you lunch, etc. It's a great way to really see what Schwab coaching is all about. So we'd love to have you joining us, everyone. Again, check out schwab.com/coaching to see where we will be. As you can get a quick look here, we're heading into January of next year. We'll be in Dallas, we'll be in Washington State, back in California, both Sacramento and San Diego, before back down to Atlanta in March. So lots of opportunity to see where we are and what we're up to. So with that, Jeff, let's jump in to the S&P 500 here. So we had a really kind of a weak finish for the week, right? You could see there's about 4 or 5 consecutive red candles there. But Jeff, we did make a new all-time high on, looks like it was Wednesday of last week. Do traders need to be at all concerned, or are we maintaining a disciplined approach, monitoring the trend, kind of sticking with things? What are traders thinking about these days?
Really great question. Isn't that what we want to know? Does the trend continue, or is this the pullback? I would probably first start with the fundamentals. So of all of the earnings releases going back the last 30 years, and all of you know I love to do some research. So the average beat rate for companies in the S&P reporting earnings is about 67%. That's again the last 30 years, with an average above estimate of 4% over that same time. This earnings season, Kevin, we had a beat rate well into the 80s. I mean, a strong 80s. It's not over, but it's still going pretty strong. And the average estimate beat rate is in the 8s. So fundamentally, things are still looking pretty good on the S&P 500. I think that bodes well for those who are looking at the fundamentals. Now, as we see on the technicals right here, I love that shelf that you just drew on there. Does everybody see what Kevin did there? You put that line in there, and what you're looking at is your previous resistance point. And as a lot of you know, your old resistance or your old ceiling turns into your new floor once you go up a story. So where might traders look to find some support? Probably around that level. We'll call that what, 67.5, 68
yeah,
or so?
67.50 or so.
Yeah. So I could see, if we do continue coming back, I could see a lot of traders saying, hey, this is where we might see a little bit of a pause. Nicely correlating too with that 20-period simple moving average that you're seeing there in orange. So, Kevin, I would say for a lot of traders out there, there is probably more of a risk on bullish appetite as opposed to a worried risk off feeling. What are your thoughts, my friend?
Well, I think we have this general underlying feel of bullishness with which I will agree. You can't argue with the price action, but what we can do is kind of set ourselves up for expectation of move, and you called it out right away there, the technical analysis 101. We broke through a band of what was resistance for a short period, about 3 weeks there, and then that band of resistance, once broken to the upside, becomes a potential new support level. And a lot of traders who are trend traders find confidence in the price action coming back down to that new support level, meaning if we come back and tested the 20-day moving average in orange, which is about 5 points below 67.50 there, that'll give confidence for new dollars to be deployed at that level. Doesn't mean it's going to hold, but it is going to give confidence to traders that are going to feel a little more likely that it can hold if we bounce down to this level, hold, and move off of it. So that's what traders are likely looking to see. As a secondary level, though, Jeff, I'm sure traders wouldn't be surprised to get another test of the 50-day, but you can see, man, the tests of the 50 have been pretty limited dating back to May. I mean, we broke out on May 1, and then we've basically had, I mean, is this considered a test? It was kind of close. I think the Friday with the trade conversation for China, where things got a little hairy in that afternoon, I think that's the closest test of a 50-day level of support that we've had. So, I think it bears watching the 50-day. I'm guessing I'm not alone in that regard.
Yeah, I agree. Also, I see a lot of the viewers out there typing into the comment section. Love that. We will do our best to keep up with those. Kevin, one of the other things I'd like to highlight here, I'm just going to show this real quick. So if you haven't seen this, this is the chart book. All right, we have these in the branch. So if you want a copy of this, head to your local branch, ask them, hey, can I get a copy of the quarterly chart book? Kevin, get this. Very expensive metrics on the S&P 500. I'm going to go through them real quick. Forward PE, trailing PE, 5-year normalized PE, price to book ratio, price to cash flow ratio, dividend yield, Shiller's Cape, rule of 20, Fed model, Tobin's Q, and market cap to GDP, all listed as very expensive. Now, we've talked about this in previous shows, Kevin, but this quote was made famous in 2007 by Chuck Prince. He is the CEO of Citigroup, and it's been shortened, so I'm going to use the shortened version. Dance until the music stops. I think those bubble conversations are probably everywhere as it relates to AI. But as long as the music is still playing, you've got to continue to dance, as the saying goes. So I think a lot of us are in the camp, hey, this is looking maybe like we're getting a little over our skis. But right now we haven't fallen down and there is still snow in front of us. So, Kevin, I think it's a very tough argument to say, oh, now is the best time to sell out of everything. But I do have a question for you. Sure. What if somebody is of the mindset, hey, this is really expensive? Should I just sell everything and get myself onto the sidelines and wait for a pullback, and that way I'll be ahead of the game? What are your thoughts on that, and how do you generally address questions like that?
Well, I think it's a valid question, but the very first thing I have to point out is that that's a different answer dependent upon whether you're a trader or an investor. Of course, if you're an investor for a long-term period of time, 10, 15, 20 years, the odds are against favoring the idea of going fully cash or fully invested. In truth, you probably are monitoring and managing a portfolio to meet up with a planned allocation of assets. Remember, if you're an investor, you don't manage risk by setting stop orders. You manage risk through diversification, by expanding your touch with your assets. You get a little bit here, a little bit here, a little bit here, and you're going to have those assets moving not necessarily in concert with one another, right? You're going to have some that are doing really well, some that are doing a little poorly, and then we manage that on an annual basis. But if you're a trader, you might very well take a vastly different approach. And in such instances, it's fine to find yourself with a lot of cash on hand. And what I often say in classes like this, Jeff, is as it relates to traders, we traders need to be thoughtful about what might come. And in fact, we need to be thoughtful about what would happen. How would I act if something I don't think is possible actually comes to pass? And I say that because traders, we get shocked all the time by price action. The key is, how do we react to that shocking bit of price action? Well, if we're prepared for it, well, then we're much more likely capable of acting in a traditionally a manner that will not put us in a bad spot, right? If you're ill prepared for a breakdown in the market, as an example only, well, then you might find yourself questioning, oh my goodness, the market's dropping. What am I going to do right now? I didn't expect the market to fall through this level or this far. Now what am I going to do? And then you're making a decision in the moment. Your heart beats faster, Jeff. Your emotions are tied to your dollars. It becomes very difficult to make those decisions. So my encouragement is just to have a few levels of price action that you think can happen, and then maybe one on both ends, upside and downside, that you don't think is on the table, but you have to consider it. And that way, if you're shocked, you know what you're going to do. You're going to say, all right, I said if this happened, I'm going to take this action. Then you're just giving yourself the playbook. That's the way I look at it. So that's my encouragement as a trader. Try to be prepared for moves you don't think can occur. Now, Jeff, we were just talking the SPX. I've already kicked us off to the NDX. The thing that stands out to me when I look at the differences between these two, there aren't a lot of differences. We've got maybe some more leadership from the NASDAQ, and yet both of these spaces have been up over the 20 and 50-day moving averages for a while. Notice the May 1 date here. We captured the 50-day on the NDX as well. We've only had one significant test, and it was back here in late August, right there. So, Jeff, can we take some comfort from the look of these two major indices working in concert with each other?
I think probably to a certain extent, yes. I also want to get to a question or two that's been coming out. Again, the name of what I just showed you, it's called the Quarterly Chart Book. This is for Q4 of 2025. We bring this out at the beginning of every quarter. This is produced by Charles Schwab. Where do you get it? At your local branch. Go into your local branch and say, hey, do you have a copy, or can I get a copy of the Quarterly Chart Book? There's a lot more good stuff in there than just what I shared. But Kevin, you got a really good point. These are moving in concert. What I think that tells me as an individual, based on my experience, is that the underlying components are probably weighted very similarly. There's maybe 2 or 3 names that are doing most of the heavy lifting, in both indexes, in the NASDAQ as well as in the S&P 500. Them moving in concert, I think, makes it easier to see what the story is. When they're diverging, now it's harder. Wait a second. One's saying one story, the other's saying another story. These are both telling the same story right now. And one of the things that's capturing my attention here, Kevin, is we had a pretty tough part to the end of the week last week. Now, come out today, sure, it's a red candle, but we're still starting to move north. I would not be surprised, and I'm not one to pontificate on what might happen this week, but I wouldn't be surprised if we test and possibly break past that previous high of 26,182 that we set last week. Again, what are we doing here? Trend is your friend until it bends, and that's when it ends. Shout out to Mr. Mark Item for that one. Right now, the trend in I think a lot of traders' minds, Kevin, is not bending. It took a breath. That would lead some to believe, hey, we've got a little bit more upside room here to go. But that's just some of the initial things that are on my mind and other traders' minds possibly right now. What do you think? Well, do you like when you see them moving in concert, or is it better if they're starting to change and move in different directions? What do you think?
I think you learn a little something if they are not moving together. So that stands out, but they are right now moving together like that. So I'd say that maybe provides a little confirmation to the trend. The interesting thing on this one to me is the gap zones, because traders often find themselves utilizing gaps as in areas of information, right? Meaning if we came down and could not maintain the lows of the last 6 sessions here, well, then many traders would expect us to at least pull back to the gap high. You know, we had this single day that stands out a little bit. Some traders would say we'd expect to find the former resistance, now potential support at the 20-day moving average. That all looks kind of a fair way of looking at things. Again, when we talk technicals, we don't talk certainties. We always talk probabilities. And if I was to just simply speak on that white line versus the green line, a close below the white line gives a greater likelihood of retest of the former resistance, now support, and the 20-day moving average. It increases the likelihood that we get there. Doesn't mean we have to, it just increases the likelihood. And then, you know, to dovetail off a question that's in the chat there about, well, if the music stops moving, Jeff, if the music stops and there's only a few chairs left, do you sit, or do you, in this case, as a trader, do you maybe sell some of your positions? And I'd like to say, yeah, you might. I mean, if you're a trader, you might even be selling into strength rather than waiting for the trend to break. It's also important to define that for yourself as a trader, isn't it, Jeff? You got to know which of these things gives you the greatest comfort. Are you the trader who likes to sell as prices are moving higher? Or are you the trader who says, I don't want to sell when prices are moving up. I am only a seller if the trend truly breaks. And then further, how do you define the true trend? I think a lot of traders right now are probably defining it as the 50-day moving average on both the S&P and the NASDAQ 100. It'll look a little different maybe on others, but I think that's how traders are probably thinking right now, Jeff.
Excellent approach. I like it. And remember too, and a lot of traders out there knows, it's not an all or none game. You don't have to sell everything at once and buy everything at once. You can say, hey, I've got a bunch of profit here. I'm going to take 25% of my position off the table right now. I'm going to keep that. And I personally, Kevin, stop me if you have, but I've never seen anybody lose money by taking profit. Not yet, anyway.
Not yet.
So if you take some money off the table, great. Now you still have some position left. If it starts to pull back, you're happy you kept that 25% off the table. If it continues rising, great. I'm happy I kept that 75% still on the table. So you're correct in either scenario when you're scaling in or scaling out of a position.
You know what? That's a great reminder. That's one of my favorite little notes, is that when you sell a little of a winning position, you're right to have done so regardless of what comes next, because the shares you sold, if the stock continues to run, you say, no problem, I sold a little, I've got some, I'm participating. If it pulls back, you could say, great, I sold some, I took advantage of a good price, and now price is retreating. I was right to have sold. I definitely enjoy being right, no matter the circumstance. It doesn't happen very frequently, Jeff, trust me. Now let's talk about small caps here, the Russell 2000. Okay. We seem to be breathing, right? We did make that intra-period high back here a few weeks ago. We got into that 25 zone, and now we're just pulling back. We've been through that 20-day moving average in orange a number of times. But Jeff, this seems to be a feeling of consolidation at an upper level. For everyone who's unfamiliar with the Russell 2000, this white line that I'm highlighting right here, this white line was the previous all-time highs in the Russell 2000. And if we back this off to a weekly, you'll see that what we're dabbling with are all-time levels. And Jeff, tell our traders here, what is it about this weekly chart that stands out for us on the Russell 2000?
Well, what you're looking at is just mass psychology. So for everybody out there, what we're doing when we're doing technical analysis is mass psychology through the use of prices. Now, go back to October of 2021, just before we hit 2022, you hit a high and then you come back down. All right, so this is our tough spot to get ahead of. Great. Then you come down, you spend a little bit of time in 2022 and 2023 towards that 17 to 1900 level. Then you come back up and you test it again, and this time you fail again. Ouch. Stuck twice so far on that level. Pull back down to your old support level around that 1700 zone. Now you're coming back up. Now this time things are a little bit different, and everybody sees that. Wait a second here, Jeffrey. We've popped past that. Ah, great. But Are we going to hold it? I've been burned 2 times before on this level. I need a little bit more confirmation. So as you're seeing this on the weekly, what is happening? It's coming back down, potentially looking to test that level and make sure, hey, I'm not going to get burned on this thing again, am I? Because this stung me 2 times before, and I really don't want to get hurt a 3rd time. So it's normal for this pullback to transpire and come about and say, hey, are we really looking at a new support zone? Or did we get faked out for a 3rd time? And that truly is our strong resistance. So, Kevin, I think that's what's probably on the mind of a lot of traders as you're looking at this weekly chart. I am, though, curious. You are much more in tune with the Russell 2000 and what's happening from a chart level. What are you thinking? What's on your mind? And maybe share some insights that maybe our viewers haven't heard of before.
Well, the one thing that stands out, if I was to apply, Jeff, just the 20-week simple moving average here, removing my 40 and 100 week, the longer term, look, we've got a ways to fall to a zone of support. If we were looking to simply maintain the trend, the reason I bring it up is that it is a good level. 23.5, we're at 24.64. So if we fell through 24.5 as an example, you might have to sustain a 100-point move to support if it's going to offer support. And that's really the question. And again, our job as traders is not to necessarily predict what's going to happen, because I feel like that's a kind of a fool's errand. But what we do is we utilize these levels to make adjustments to our positions along the way. So if we closed under the green line, for example, on a weekly basis, some traders would say, that's a good reason for me to lighten up my small cap positions. And then let's see how we act. Do we get supportive at the 23.5 and the 20-week moving average? If so, those traders who took money off up here might feel more compelled to add that money back. But again, it's a process of defining your comfort, defining your willingness to deploy money when and where when things are moving for you. So, okay, so we know, Jeff, that with regard to the Russell, we have a lot of price action tied to yield. So let's look briefly at the 10-year yield. And what we find here is that we have rallied strongly in the last week and a half, 2 weeks, into former resistance, Jeff. So while the Russell is in process of maybe a little bit of a red day today, perhaps a little bit of pullback, this is a little bit intriguing because this the yields have actually rallied into a spot of resistance. And if this starts to do what it has done for the better part of the last 5 months or so, could traders maybe anticipate an even bigger move to the downside from this recent rally? Meaning we've run into a rejection zone. If we get a rejection, do we at least expect matching lows, if not lower lows?
Well, right. This is technical analysis 101, everybody. Lower lows and lower highs is a downtrend. Right now, you are seeing lower lows and lower highs. This is classic bear movement. Now, the point that you probably want to capture here is what Kevin just highlighted. You notice that purple line, that's your 50-period simple moving average. That is your now potential resistance level. It has failed numerous times when it has tried to get above that. I don't know if it's going to hold that or if it's going to go above it or not. But this is one of those times where you're saying, hey, if I was going to take a bullish position on this, you would know relatively quickly whether or not that worked out. So if you're looking at risk to reward ratios, not a bad idea. If you're saying, hey, I'm going to know pretty quickly whether I'm right on this trade or whether I'm wrong. So as you're looking at moving further with the 10-year, one of the things that you may want to keep in mind is, are we going to see another lower low and this being a lower high? Watch for that level. And Kevin, you can kind of see it. I'll call it early October. You kind of came up, down, and then back up again. We'll call it 41.80. Yeah, somewhere in that range. If you can break above that, now you might have yourself a little bit of an argument to say, hey, we are no longer hitting lower highs. We just hit a higher low. Okay, great. Now what are we looking for? In addition to that, you need to hold that support level. If you get up to that level, that's a good first start right there. But then you need that follow-through confirmation. You need to pull back down to that 50-period simple moving average, hold that, and then start moving higher. And you might say, I think we really got something here, Kevin. What are your thoughts, buddy?
Yeah, it's exactly that. I mean, if you're a Russell 2000 owner, then you know that there's bet merit here in yields going lower. It's going to support the move to the Russell to the upside. Very much tied to interest rate movement. So that's what we're paying attention to. It's an interesting spot right now because where we reside in the trend here on yields. Yields have come down aggressively. The market has been rallying since then. I mean, we peaked in yields in mid-May, mid to late May, right around the 21st, 22nd of May. Now, that wasn't the bottom of the market drawdown, which was April 7. Of course, along when we were still trying to figure everything out on yields too. It wasn't just an equity sell-off. We were trying to figure everything out back in April. But basically, since May, late May, we've been in a downtrend, and it's been very supportive of the Russell 2000. So wanted to make sure we discussed that. Okay, so there's your S&P 500, your NASDAQ 100, your Russell 2000, and yields. Jeff, let's talk about that leadership group, the semiconductors, which are still in gear. The trend resembles a lot of the NASDAQ 100. We've got some gaps in the last 2 weeks that have been affording traders an opportunity to start watching a faster trend. My traditional 20 at orange, purple is the 50, and the 200-day way down below might not be fast enough. We've been trending against the 20, but since we broke out here after that 3-week consolidation, it looks to me like the 10-day moving average is not even fast enough to provide short-term traders an opportunity for an exit strategy. I mean, it feels like you're leaving yourself a little bit over-invested here. The fall to the 10-day moving average, Jeff, right now is about 200 points.
That's a decent distance. Kevin, talk to me a little bit. What are our thoughts on the relative strength index down there?
Yeah.
Coming up to new highs, and it was in the 80s, and then we now break to a brand new high, but we're in the 70 range. What might somebody pull from that?
Well, at this point, it's tough to say because we've been seeing a lot of bearish divergences along the way. That's what we would call this, by the way, everyone. We've got a bearish divergence because we've got price continuing to make higher highs. The last time we made a higher high in the RSI was back here in early October. And you can see that the RSI is not into overbought conditions above the 70 line. So we would call it a bearish divergence, Jeff, but I'll have to remind all of our traders, we talk about bearish divergences frequently because they are appearing frequently. Eventually, it's going to be apt that it'll matter for us. Right now, it's not. We continue to see price moving, and I think that's the key. Trend and price are what matter more. Most of everything, right? Price is king. So let's not overdo our thought process. Yes, we have a bearish divergence, but Jeff, divergences like this, whether it's RSI or MACD divergences or stochastic, the reminder isn't that they lead to reversals. It's that they often lead to pauses in the trend as opposed to actual reversals. So a pause in the trend, Jeff, might just mean we go sideways above this 7,075 ledge and just hold that level and allow these moving averages to get caught up, kind of like what we did back here, where we just did the exact same thing, right? So I think if you're a trend trader, that's kind of what you're maybe hoping for, regardless of what the RSI shows us down below.
Gotcha. A little bit of a breath moment. Take a breath. We're running a marathon. It's not a sprint. Gotcha.
Exactly that. Now, my reminder for you traders is that just because you're monitoring a trend one way doesn't mean you can't take action with your positions. And so one of the other reminders that I like to offer traders is that if you're feeling uncomfortable might mean a little bit bearish, but don't forget, in order to be bearish, it might just mean you take dollars out of your investments and build cash. You don't have to take bearish positions to be bearish in the marketplace. You can be bearish by simply building cash and waiting for an opportunity that makes you more comfortable than what you might be witnessing now. I don't know what's coming in the market. I only know the trend based on what we've seen for the last 6 months. So that gives us as traders some areas where we would take action. But right now, I don't know what's coming next, Jeff. I certainly don't know what's coming over the next week. Plus, I don't know how long it's going to be before, and even if it is going to matter, where we start looking at the number of days the government's been shut down. At some point, you would have to believe that these things will have an impact on the broader market, but we haven't seen it play out that way.
Yeah. If you do know that information, if you happen to get a crystal ball or something cool like that, let me know too. If you could just shoot me a text, doesn't have to be anything formal. I would definitely like a heads up on what's going to happen because I also do not know what's going to go on from one day to another.
Appreciate that. Yeah. If anyone wants to share, y'all feel free. Feel free to share. Follow me on X.
We're here.
You can do that. Okay. Jeff, we had some requests to look at some of the precious metals, so I thought briefly we would utilize some futures quotes, but we're not going to do this from a standpoint of trading the futures. So just be aware we're going to utilize futures quotes to look at gold, to look at silver here, just for an understanding of the trend. So we'll hit up gold with /GC. And Jeff, we've seen there's been a bit of a pullback here. Look at how long we've been under the 20-day moving average now in the price of gold, Jeff. We're at day 1, 2, 3, 4, 6 days consecutively below the 20-day. I'm sure now traders are wondering, have we found support at these recent lows?
I think it's really tough to say, and the reason you all tend kind of picking up my hesitation here, you've got that level that Kevin just marked. I don't know that that's what captures traders' attention as much as the 50-period simple moving average. Now, we did have a down day and then that up day, so it did get some attention certainly, but I think it may be a little bit too early to tell. Yes, it's been down 6 days. What that would give me instruct on, as opposed to what may happen on the lower level, is, all right, we know we are probably out of the big bull run. What happens with that 20-period simple moving average? Seems like there's some bullishness right now where people who had gotten in towards the high of this gold run are saying, could we get back up? Let me buy some more. What happens with that 20-period simple moving average, I think, is probably most on the investor and trader's mind right now. If that can't hold, so let's say you bump your head against it and they can't break through it, then I would imagine that 50 period, which does kind of tie into the zone of the white level that you've highlighted there, Kevin, that may be what really gets a lot of attention. What you generally don't want to have happen, for those of you who are in gold right now, who are bullish on gold, what you really don't want to see is a sideways movement. The more time you spend below that 20-period simple moving average, the harder it is said to be to get back above it.
It's true. Yeah, that's a great reminder. A couple of the key levels here, Jeff. Number one, you do have declining volume into the support ledge. That's what traders who are bullish want to see. Further, the RSI, which was in overbought condition here for an extended period of time, has now come down to an area that traders would say is supportive in nature. If you've been utilizing the RSI, reminder, the RSI works best in sideways markets, okay? And then you can rely on overbought conditions over 70 and oversold conditions under 30. But if you're watching a strong trend, whether it's a strong bullish trend to the upside or a strong bearish trend to the downside, remember that the mid-level, the 50 line, is an approximation, and many traders would say between 45 and 55 in the RSI, then becomes your condition of overbought or oversold. So in the midst of an uptrend like this one, very strong, we got the RSI to pull back to a level at 45 and change. Now it bounced off of that. Many traders would tell you that that is confirmatory of the strength of the bull run we've seen, and coincident with a support test in price, they might feel comfortable deploying money based on such a pullback in the RSI, meaning they don't want to see it get down to the 30 line, okay, and in true oversold conditions, because then that might suggest that the bull trend we've seen could very well be over. But we haven't done that. So some traders would say, so far, you've got bullish behavior as it relates to the RSI, even though it has pulled back significantly. Now, Jeff, let's take a peek at that same look with silver, and you're going to see it's pretty darn similar, isn't it? Yeah. The difference here is silver has led us lower. We're actually in week 2 below the 20-day. And Jeff, look at how the 20-day, while flattening out, has been acting as resistance. 1, 2, 3 highs, all at the 20. 1, 2, 3 highs at or through the 20. I think it's well defined that the 20-day on silver here looks pretty important.
If I drop down by just a little bit, I'm out. That no longer is going to be the case. That thesis of I am anticipating a break above that resistance level. So setups like this, even though you are hitting a resistance level, they're not necessarily a bad thing, because they do give you a little bit of a benefit on that risk to reward ratio, Kevin.
True. Risk reward should also be part of the thought process for traders, not so much so for investors, of course. Remember, our trading process is fairly different than that of an investment plan, of course. So, Jeff, I'm noting we're seeing a little bit more red on the screen. I thought, let's blow this out a little further, talking about some of these other industry groups. So we've looked at gold, we've looked at silver, but one that we haven't peeked in on here today is the transports. And I think it can be important. My chart on the transport is a little bit messy, but I'm going to show you why. And the reason this chart, this daily look at things, really doesn't speak nearly as well as a longer term chart. And in fact, I've got one built for specifically Dow Theory. And Jeff, this is the Dow Theory breakdown. So what we have on the left-hand side are the Dow Industrials, and what we have on the right-hand side are the Dow Transports. Now, if you're a Dow theorist, going back to the late 1800s when Charles Henry Dow built this concept, then you might be looking at this saying, well, we've got a divergence. We've got highs in the industrials, but not highs in the transports. And that could tell us that we're not getting confirmation of our bullish trend. And Jeff, there's plenty of other technical analysis 101 details playing out up here. An uptrend line that was broken went from being supportive to becoming resistance. You'll notice that we banged our head on that 16,240 zone a number of times. We were incapable of holding it. Now we are holding a ledge of support, but we still have not gotten out of this stuff, and we haven't been able to get back above this. And this level, this white line level, becomes very important if we want to believe that such a lengthy viewpoint, Jeff, a 150-year concept, if this still is valid for our markets, this is something we would prefer to see. We would much rather see the transports trading above that 16,200 zone than languishing where it is here. Can you speak to this stuff at all?
I just have to say, Kevin, insights like this are exactly why I tune in every day. This is not a conversation, and I'm in a lot of different groups in work. I've got the Chartered Market Technician channel here. I've got active trader channels. I've got all sorts of things. I'm reading the Wall Street Journal avidly. I'm in a ton of publications. Nothing has mentioned Dow Theory like this before, and this is so important. It's so foundational, Kevin. Again, this is why I tune in for insights like this. So thank you very much for bringing this to the fore. But you're absolutely right, buddy. You would want to see a confirmation of the industrials and the transports. That's not happening, which you go back to Charles Dow. What he's saying is the trains aren't moving the products along the lines to fuel the market capitalizations that we're seeing in the companies. That is a bit of an issue. And I would agree, if you're going with Dow Theory, this is a little bit of an uh-oh moment where you say, hey, we might have ourselves a bit of a canary in a coal mine at this particular time when we're looking at these two. I just got to give you a big applause, buddy. Absolutely incredible. Thank you very much for bringing this into the conversation. I hope everybody continues to look at this throughout the week, month, and maybe even the rest of the year.
Thanks, man. I appreciate that. It is Halloween still, so I guess I could play the role of a market technician here. Sure. No, let's talk about a couple other things. Number one, is it notable? The current breakdown of these two charts, it's notable. That's it. Yeah. That's all we're going to say about it right now, because if we stay between my two white lines, then everything just remains something to watch. It's when we take this out, I would say, that things get dicey. Okay, if we traded the transports under my bottom white line of support, things could get quite dicey there on a weekly viewpoint. So let's monitor for that. We don't know if that's going to happen. We know what we want to see happen. We would much rather trade through the white line above and make some new highs. Okay, now let's shift the conversation very quickly to what some traders suggest is the new Dow Theory, Jeff. And that is a breakdown that says we don't need the transports and the industrials, but rather the S&P 500 and the semiconductors. Now, the reason for that speaks to the shift in our markets. This market today, 2025, is vastly different than the market in, say, 1900. We used to be a very different economy. We are nothing but consumers as an economy these days, Jeff, and hence some of this discussion around our leadership. So many traders in the new thought process might suggest that monitoring these two validates our trend. That said, isn't that one on the right pretty steep?
Yeah. Parabolic maybe is not the word we want to throw out right now, but gosh, that thing has moved up dramatically, hasn't it? And again, if you look at charts historically, these very steep slopes don't necessarily mean that everything is going to crumble tomorrow. You actually have no idea when it's going to happen. But it is a little bit concerning when you say, wait a second, we're making a lot of money in a very short period of time. Let's go back historically. How fast has money been made? And you say, we don't see a lot of those types of slopes throughout history. This might be a little bit of a yellow flag moment, Kevin.
It could be. We're not going to overreach. We're not going to overthink things. We could apply our standard moving averages. I've got some weekly simples in here. Again, my green line is now my 20-week moving average. Way, way too slow. Look at the difference there, Jeff. You got to give up 11, almost 1,200 points to the 20-week moving average. If you're going to utilize that for validation of a breakdown, some traders might say that the 20 is not fast enough and they may change it to a 10-week instead. So let's just see how that looks in the green line. And you can see that's a little bit better. But again, if you're wondering about trade management and you're thinking, oh, I can fall down to the 10-week moving average and be comfortable, well, you're giving up 700 points, 10%, to just fall to support. So the question is, are you willing to give up 10% of your profits so that you can, or 10% move to the downside in the form of profits just to be proven wrong about the trend changing? That's a fair question to ask, right? And again, that leads you to, I hope, a discussion around trend analysis in conjunction with trade management. How am I going to manage my trades if this goes this way, or if it does, in fact, pull back?
Well, so I've got the weekly stocks on my radar now, buddy. Thank you very much for bringing this to my attention.
Excellent. Okay, Jeff, we are almost at time, and I'm so sorry that we are, because I know it's been a wide-ranging conversation. We only go about 45 minutes in total. There were a couple of stocks that were upgraded today that I just wanted to pull into the discussion because they are known positions. So let's talk quickly about Netflix. I'll let you have a look at the technicals. It looks like I've got an example trade working in here. But Jeff, they've gone to an important ledge of support. Netflix was upgraded at KGI Securities to outperform from neutral, a new target set at 1,350 per share.
Intriguing. So that must be based off of fundamentals. There maybe was something on that earnings call that was capturing that analyst's attention. So as we look at Netflix from a technical analysis standpoint, 200 very much capturing the mind share of the traders out there. Probably what you may be seeing is, all right, let's say we hold this 200 period simple moving average. You now have that 20, and then immediately after that 50 to get past. That's two very short-term, near problematic resistance levels, Kevin. I don't know if I was somebody that was saying, hey, I'm looking for a bull trend, that Netflix would be the first company that I jump at. Now, if you're willing to wade into those waters, great. Again, you've got a good probability on the risk to reward where you're saying, if I go up, fantastic. But if I come down, I can very quickly get out of this trade because I know I'm wrong much faster than if I were to say, look at the SOX and I'm having to drop 10% before I see a problem with my trade. What are your thoughts on that?
Yeah, much the same. I think traders, if you saw a new short-term low created here, trading under 1,088 or so, that would not be fantastic from a trend standpoint. Probably means a deeper pullback. But as Wiley is pointing out, reminder, we do have a new notification. Last Friday, they announced a 10-for-1 split. So they are going to be cutting the price level, that is, by, from, if we close at 1,000, we'd see it trading at about 100, right? Now, everybody that owns it is going to get those shares, so it's going to be a net break even for the majority of holders of the position. But that could have an impact for sure on maybe some of the volatility the stock has witnessed by eliminating a lot of those shares or doing the split, Jeff, and pulling that price down. Essentially, you're just losing power, if you will, for every tick to the upside or tick to the downside. So it might remove some of the volatility of the position.
Good call out.
Okay, and then, I don't know what else we could cover in another 60 seconds, so I'm going to use that as our opportunity to wrap up, everybody. I really appreciate y'all being here. I know we had so many new attendees today, and I always love reminding our newest attendees of what we are up to here on the YouTube coaching channel known as Trader Talk. So remember, we are here every day, Monday through Friday, from market open until about 5 o'clock Eastern time. That gives you 6.5 hours of live content every day, and the majority of that content is archived and made available for you there on the channel or via that calendar, schwab.com/coaching. So, Jeff, I love having you here once a month, man. I only wish we
here.
could do it more frequently, but thank you so much for sharing your thoughts, sharing your insights, and participating in the show today, of course.
Truly my pleasure. Thank you for having me, Kevin.
Of course. And to all of you, thanks for being here. Big thanks to Brent Moores in the chat. I noticed we did see a survey. He just reposted that. Your feedback is invaluable to us as coaches. If you take just 2 minutes to complete the survey, you're welcome to make some comments. If you make comments, they come directly to us, and I will absolutely read those, work to incorporate those in upcoming and subsequent sessions as well. So thanks once more for being here, everybody. Hope you all have a fantastic Monday, a first November trading day of the year. Look forward to catching up with you all again real soon.